Okay, hello and welcome. My name is Gabriella Kuz, and I'm a director with the Global Digital Asset and Cryptocurrency Association. Today, we will be featuring an exciting panel of representatives speaking on the subject of the U.S. Commodities and Futures Trading Commission guidance for FCMs holding client virtual currencies. Before I turn it over to my colleagues, I just wanted to provide a few ground rules. As this is a professional level event, we do ask that any questions or responses to questions are kept respectful and professional. During the course of this event, attendees will have the ability to share their questions and responses to questions through the provision of the QA box offered on the bottom of the toolbar on your screen through the Zoom platform. All questions pertaining to content should be directed to the QA box, and this will allow you an interactive opportunity to engage with our varied panelists and offer insight as well as questions on the coverage of the topics today. Additionally, any questions that you have regarding connectivity, audio, or visual should be directed to the chat function, where myself and my colleague, Kat Orfanos, will be responding. If you have any questions, please let us know. We're very excited to welcome you here today. And as a final reminder, this event is being both recorded as well as broadcast via live stream to our participants via YouTube today. As we have an attendance of over 400 interested and excited professionals, I'll go ahead and turn it over to my colleague, Jeff Kleinops. Jeff? Jeff, I believe you're muted. Please unmute.
It's 2020, I guess. You know, we do so many of these and problems are normal. Anyways, thanks, Gabby. Hi, everyone. I'm Jeff Kleinops, Head of Business Development for DrawBridge Lending. Thank you all for joining us. We have a great panel for you guys today, and I would be honored to introduce our guests. We have Brian Quintenz, who is the Commissioner of the CFTC. Brian was nominated by both President Barack Obama and President Donald Trump to serve as the Commissioner of the CFTC. He was unanimously confirmed by the Senate and was sworn into office in August of 2017. Prior to his appointment to the CFTC, Brian founded and served as the managing principal and CIO of a registered commodity pool operator. He began his career in finance at Hill Townsend Capital, a long-short U.S. equity hedge fund, which focused on the banking sector during the financial crisis. Prior to working in the financial markets, Brian was an aide on Capitol Hill. So Brian, thank you very much for joining us today. Next up, we have Chris Ferraro. Chris is the president of Galaxy Digital. Prior to joining the firm, he was a managing director and partner at HPS Investment Partners, where he worked within the direct lending and special situations group. Previously, he began his career at BlackRock Kelso Advisors, which was an investment manager for a publicly traded business development company focused on structuring and executing middle market structured debt and equity investments. He holds a BA in applied mathematics and a BA in economics from Yale University. Chris, thank you again for joining. Next up, we have Laura Edelman. Laura is head of institutional market development at Bakkt. Bakkt, for those who may not already know, is majority owned by the Intercontinental Exchange, a Fortune 500 company and a leading operator of global exchanges, clearinghouses, and a provider of data services. In her role, Laura is responsible for driving the growth and success of Bakkt's market development and launching new trading products globally. She previously led sales and business development for ICE and is based in New York. Laura, thanks for joining. We have David Klotz. David is a 20-year futures industry veteran, and he currently is head of business development for Phillip Capital. a FCM and a securities broker-dealer, and is the U.S. affiliate of Singapore-based Phillip Capital Group. As head of business development, David interacts daily with Phillip Capital's global affiliates, exchange partners, and industry vendors to provide solutions for their global multi-asset clientele. Prior to Phillip Capital, David was most recently a director in the futures division of Mizuho Securities, overseeing the global electronic trading support team. David, thank you for joining us. We have Stephen Hood, who's the head of risk for ED&F Man Capital Markets. Steve has 20 years of industry experience in all aspects of risk management for an FCM as well as a broker-dealer. He has extensive expertise in trading and detailed risk analysis of capital markets products. He has successfully engineered and deployed multiple enterprise risk management frameworks, and most notably, he has been nominated as a member of the CME Clearinghouse Risk Committee, the DTCC Risk Advisory Council, as well as ErisX's Risk Committee. Steve, thank you for joining us. Matt, as our moderator, I will let you introduce yourself and take us forward.
Thanks, Jeff. I'm Matt Lisle, General Counsel of DrawBridge Lending and current chairman of the Global Digital Assets and Cryptocurrency Association, or GDCA as we know it for short. As mentioned before, the GDCA is a co-host of this event, and the GDCA recently launched in early October, seeking to establish a nonprofit organization that will be comprised of members of the digital asset and cryptocurrency industry. Oh boy. Sorry about that. Of the digital cryptocurrency industry that believe that industry self-regulation is the most efficient model. Quite simply, we're seeking to set up an organization to do two things: establish standards and rules for the industry through member consensus, and create an enforcement mechanism to uphold those standards. To do this, the GDCA will also need to provide education and advocacy on behalf of the industry, which is the central reason the GDCA is co-hosting this event. To educate the industry about the aspects and impact of the recent CFTC guidance on accepting VC or virtual currency from customers into segregation accounts. At our launch event earlier this month, we were privileged to hear from Dr. Richard Sander. Dr. Sander, who self-deprecatingly refers to himself as approximately 700 years old, has certainly seen a lot and has been a careful student of quite a few commodity market evolutions. Dr. Sander described the stages of evolution all commodity markets generally take, from the fundamental event or cause that leads to new commodity market needs or innovations. For example, the need for the Dutch East India Company to finance trade with India, or the Western US demographic expansion of the housing market and the need to transfer capital from the East Coast to the West Coast to finance those mortgages, to climate change, and currently the change from the LIBOR standard. All of these things are significant events that require innovations in the marketplace. In each case, the markets initially feature transactional structures that are bespoke in principle or person-to-person transactions, what we refer to commonly as the spot markets. Over time, the markets eventually morph into sophisticated marketplaces designed to more efficiently price commodities by leveraging the process of the transfer of risk from those who are looking to hedge themselves against price risk to those looking for profit-making opportunity by taking on risk. Now we're seeing the same evolution happening in the cryptocurrency markets. Crypto started as an idea, a quaint novelty at first, bespoke transactions between private parties. But as more people got involved, electronic exchange markets developed. Now there are active and liquid spot markets, and exchanges have launched futures and options on Bitcoin and Ethereum. In order to facilitate the market's continued development, the legal and regulatory framework needs to be created, revised, and reshaped. In that vein, the CFTC put out guidance last week that will help the continuing development and evolution of the marketplace by a more direct link, or facilitating a direct link, between the spot trading platforms like Coinbase and Bittrex and exchange traded futures and options on Bitcoin and Ethereum. So without further ado, let's get into that guidance. And the first person on my panel I'd like to turn to is Brian Quintenz. Brian, could you give us some general comments about the guidance itself and the CFTC approach?
Well, thanks so much, Matt, for having me. And thank you to the Global Digital Asset and Cryptocurrency Association for, first of all, the ambitious idea that you have for the association to develop a self-regulatory like structure and powers and capabilities to continue to add vibrancy and integrity to this fascinating and what I think is going to continue to be an incredibly important asset class going forward. And I'm very pleased to participate with you today. So we're talking about staff letter 20-34, which came out about a week ago. And I'd like to maybe provide some context for that, maybe give a little history, talk about the impact, and then talk about the future. And to maybe ruin the punchline a little bit, I think, what's the impact of this? And I think the answer is not much, but I don't think that that's a bad thing right now, and it's as much as we could have done with this kind of letter and response. So let me address what I mean by that. So a staff advisory from the Commission doesn't set new policy, and it is certainly not a rule. A rule has to be voted on by all the commissioners, and that is governed by the Administrative Procedures Act, which requires a notice and a comment period and solicitation of input from stakeholders. And that is the process that we as a commission follow when we are undertaking new and especially complex rulemakings into what would be uncharted territory at this point. What this actually tried to do was to say, because we are now seeing an interest by exchanges and associated clearinghouses with involving intermediation in their markets, how should FCMs account for cryptocurrency, digital assets in customers' accounts according to our segregation requirements? And so from that aspect, we're constrained by what our current rule set is from a staff advisory perspective. I'll get more to what the potential is in a minute or two. But what the current capabilities of our rule sets allow is actually, if you go back 20, 30 years, we never even allowed treasuries or equities to qualify for kind of a client's segregated requirements. Fast forward to 2001, where under 1.32, one of our regulations, we recognized the SEC's regulation of 15C31, which is basically their kind of capital rule that that ranked and tiered other kinds of securities, including treasury securities and equity securities, or what they call marketable securities. Marketable securities, by as defined by the SEC Rule 15C31, are equities traded on a securities exchange. So if we're thinking about that and that history, and we haven't changed that rule, which we could only do through a public rulemaking, the only way that we can speak to crypto assets being held by FCMs for customers or in customers' accounts is in accordance with that. And what this advisory did is basically say, until the Commission is prepared to undertake a rulemaking, again, which I'll get to in a second, we have to view these crypto products, digital assets, more as warehouse receipts, more as physical commodities from a segregation requirement, which does not allow them to be used to top up, a customer's requirements. I think, as we look further down the road, I don't want anyone to take away from this that this is a final word and that this is a value judgment that the Commission is placing on this space or on these products themselves. I think it was an immediate step that we could take to provide some level of guidance to allow for intermediation with exchanges that are dealing with these products and accepting cryptocurrency as a part of customers' accounts. But I think that there is the potential for, and I would certainly support us looking at revising our segregation rules to potentially account for these assets. Now, that brings up a lot of complicated public policy issues that I think we as a commission would have to consider in terms of what would happen in bankruptcy, given either a potential for a cyber attack on these products specifically, or from a volatility aspect and how customers would be treated according to our traditional pro rata distribution in bankruptcy proceedings by FCMs. I think it also probably brings up a lot of interesting questions from stakeholders. I mean, I think that there would be some stakeholders that would say, absolutely, yes, you need to accept, digital assets within this seg context. And I think that there would be others, and I think at least one very large asset manager has publicly stated, we want to know if there's an FCM we're using that would do that, because that would bother us. So I say that, again, not to take a side, but to put this in context that it's an advisory done under our current regulatory rule set, which limits what we could have done in it. And I think it would be appropriate for us to reconsider this in the future, but that's going to involve a lot of public discussion with a lot of stakeholders. And if anyone on this call has views, I think that will be an interesting discussion to have, at that point. So let me leave it there, Matt, and
Sure.
I'll be happy to answer questions as they come in, maybe at the end or during the panel from other participants.
Okay, well, thank you, Brian. And I was remiss, but let me add that I do want to recognize that the CFTC in general and all of the commissioners and the chair have been pretty actively engaged with this innovative asset class. And I would even go as far as saying you might be in the vanguard of U.S. regulatory efforts in this aspect. And kudos to you. And it was a pretty good explanation of the pressures that you face. And those pressures, maybe they're not pressures as much as you're trying to balance a whole bunch of different interests and risks. And so, we totally understand that this is going to be a procedure, a process that needs to be careful and well considered. So thank you for that. I'm going to turn now to Laura Edelman from Bakkt. And Laura, I'm going to ask you this. Is this guidance helpful to Bakkt's business? And if so, in what ways? Is this a plug and play kind of a thing? Or are you going to be doing some more work or need to do some work on your end?
Yeah, sure. Thanks, Matt. I think that, the guidance that this letter kind of gives the space is it's really positive for us. It's positive for the space, for the traders. I think it's a big step in the right direction for building confidence in digital currency derivative trading, really. It shows that the CFTC is thinking about protecting the traders, our customers. I think it will ultimately lead to a more efficient, regulated marketplace. As Brian mentioned, there's definitely a lot of work to be done, both from the regulator standpoint. Sounds like they have a lot more thinking to do and more things that have to be done in the background from them, but also, from the clearing member perspective, excuse me, and from the exchange perspective, we're excited to be able to have our clients utilize digital assets and trading on our exchange and trading our physically settled futures contracts. We think that it's super important because it'll free up capital inefficiencies that exist today. It creates way more opportunities in our market, which in turn will create more volume, which will in turn create more interest from outside parties, outside participants. So it's a good snowball effect that eventually will create an efficient, regulated, physically settled futures market. And I think that's really important to have because that provides price integrity in the space. And, that's why ICE and Bakkt constructed our contracts this way so that we would have physically settled contracts to provide this kind of price discovery for the market. And I think this kind of guidance will lead to an efficient market that will lead to this kind of price integrity. So sure, there's more work to be done, and we're happy to put in the work. And I think our clients will be really happy when we get to the point where we are looking at using digital assets as collateral and funding for these markets. I hope that answers your question.
Yeah, thank you. And I also, while I'm on with you, I also wanted to address the issue of what a depository is under the Commodity Exchange Act, and how does that work in terms of the Bakkt environment?
Sure. So something that the advisory letter talks about is, or gives guidance on, is it talks about first a myriad of risks that are associated with keeping your digital assets in an unregulated custody or exchange. The fact that it could lead to loss of assets, which have actually happened very recently. There's been some massive news, with BitMEX and, the criminal charges that the executives are facing. On top of that, just right after, there's another Chinese exchange, OKX, where clients couldn't even, their digital assets were locked up. I mean, could you imagine, not being able to withdraw your own money from an exchange? So these were all highlighted in this advisory letter. And then, to this point, they kind of said, the guidance that they gave were, okay, so if your clearing member is going to, safeguard your client's virtual currencies, it needs to be with a qualified custodian or at a bank or like other clearers, for example. These are places that are regulated. They have either on federal or state level, they have a myriad of institutional grade procedures and protocols in place for safeguarding the assets. And right now, your traditional banks, your Bank of New York Mellons, that they're not supporting these digital assets currently. So custody does play a really big role and creating trust in this space. Luckily, Bakkt does have a custody. We are actually a qualified custodian. We are regulated by the New York Department of Financial Services. So it checks all of the boxes that are in this advisory letter and more. We have, from a cybersecurity standpoint to a physical security standpoint, the warm and the air gap digital asset storage, we rebalance HSMs, and we have a viable insurance policy, something that's touched on as well in the letter. So, it's something to consider, where you want to keep the storage and the safekeeping of your assets with respect to just standalone custody or with respect to physically delivered contracts. And it touches on, like I said, everything that the CFTC kind of is pushing the clearing members to look at when they're putting this framework in place.
Yeah. I'll point out too that Brian added that perhaps one way to look at the guidance is through the lens of how you hold warehouse receipts. It's the same sort of indicia of title, and within that environment, that secured environment. We at DrawBridge Lending, we use crypto collateral, and we need to depend upon our collateral holders, which are custodians like Bakkt, like other licensed depositories that are audited, regulated, and those kinds of things. And so, I think as the industry matures, we're going to see a lot more of this becoming sort of de rigueur and just, people might even take it for granted at some point. But right now, Those are the questions we need to ask, especially in light of like what happened in OKEX. I want to remind the audience that there is a question and answer, a little button that you can use if you want to ask some questions of any of the panelists. Please feel free to do that. At this point, I'd like to turn to the firms. We have two firms here, ED&F Man and Phillip Capital, and both are FCMs under the CFTC regime and framework. And the first person I'd like to bring online here is Steve Hood, who's at ED&F Man. Steve, looking at the guidance, does it do anything for ED&F Man in your view?
It does. It prepares us for the next step. Just before I answer that question, we just kind of do want to commend the CFTC with their approach to crawl, walk, run. We've done the same thing. Just turn the clock back. It started with Bitcoin futures that were cash settled. They add options. Then you have the physically delivered product. The next logical step is really getting crypto into SEG. And that's kind of where we are. We're really dipping our toe in there. And then just wearing, the CRO hat here as well. Just looking at Bitcoin, people were wondering, what does it look like during a time of volatility? Well, guess what? We just experienced a pandemic like nothing we've ever seen. And just wearing my CRO hat, one, I'll look over here just because the market's selling off. But then two, Bitcoin wasn't on anyone's radar in terms of it was the crude move, it was natural gas, it was VIX as well. So I do think Bitcoin showed maturity during this time. The liquidity was there. So those next logical steps to really integrate it more into the capital markets is really there. But to answer your question specifically, more needs to take place. What we can do right now, and we look at it as almost an LC. That's the way that I akin it to. So yes, we can allow all the different rules. Someone's got crypto, it's at Bakkt, they're selling a future against it, and they could have that crypto offset the requirements. But still, as an FCM, we have to take a capital charge as well. But again, I don't think we should be looking for leaps. I like the idea of these baby steps and getting everyone ready, because there will need to be changes in terms of, you talked about it a little, actually all three of you did, kind of the vetting of warehouses, the custodians, processes, what happens if someone doesn't meet a margin call, enhancements to back office systems. And then as well, we are a regulated broker dealer, and so just doing things in conjunction, with FINRA and with the SEC. But I do think, I just want to, shout out to Brian again in terms of kind of moving this forward in a way that I think it's trying to keep everyone happy. Sometimes when no one's happy, that means that you're probably doing a great job. So we like where it is. We like the cover of the CFTC, and as more people get comfortable with it, we're going to be there and, want to, because the demand is there. The demand, especially with even before the rally that we've seen recently, the demand is there from our institutional clients, our professional trading groups, the more sophisticated clients that we have as well. That's what I have, Matt.
Okay. Thanks, Steve. I'm going to turn to Dave Klotz now from Phillip Capital and ask him, Dave, how is Phillip Capital looking at this guidance? Will this be helpful to you?
Sure. So thank you, everyone, for letting me participate, first of all. Phillip's been actively clearing crypto derivatives since the CBOE launched back in 2017. So we've really watched it evolve over the last 3 years and have benefited from the experience. We feel that this is, echoing the sentiment of Steve, that this is a plank on the road to further regulatory acceptance. We have to look to, all of our DSROs and all of our regulators, both as a FCM and clearing broker dealer, for guidance on this, and the CFTC taking the lead is very helpful. So, as the regulators, that being SEC, FINRA, and our DSRO, the CME group, come together and coalesce around more guidance, it'll lead to the path of further acceptance for the product.
Okay. My next panelist is Chris Ferraro. And Chris is from Galaxy Digital. And I know, Chris, you Galaxy has multiple business lines, and many of those lines are regulated and maybe quite heavily. That includes managed funds business, and I think you have a broker dealer. Does this guidance, in your mind, create any opportunities for Galaxy?
Yeah, sure. Thanks, Matt. Yes. So we operate a regulated broker dealer at the firm. We operate an SEC regulated RIA in our asset management division, and we're a publicly traded company as well across in the Canadian jurisdiction as well. And so we're regulated by the Canadian securities regulators as well as the TSX as a main board exchange. And so we deal with a lot of this all the time, and we've purposely built the company to fit within the regs and to pull along what has been a young industry so that it can meet the institutional demand when it hits. And I think, as everyone has said, it's hit this year in a really big way. And so from where we stand, we're an active market participant ourselves. I think literally everybody on the screen, we're in some way we're a client of or a partner with, but more importantly, we're really focused on providing market access to institutional, large, traditional asset managers, investors, PTGs, and so from a giving clients access perspective. And from a giving clients efficiency of capital and financing perspective, the steps that are at least being outlined to be taken here are all helpful. I think from the beginning of crypto, liquidity has largely pooled outside of the U.S. And I think the best thing that could happen to the industry for all of us, Bitcoin holders to service providers to market maintainers would be to have liquidity find its way to the biggest, best, most regulated, most above board sort of market in the world, maybe the U.S. And so however we can make that happen along the right timeline, in my opinion, is what we should do. Now, the last thing I'll say is the double-edged sword to that is, and this is where I think Brian and the CFTC are spot on, is the worst thing we could do is do that too quickly and have an event that puts a tarnish on the industry and puts a speed bump in the growth of adoption of Bitcoin and other digital currencies. And so, the pragmatic approach of taking individual steps before we get to full access, full capital efficiency, and leverage, I think is prudent, because I'd rather win the long game than try to win the short game and lose our footing.
Thanks, Chris. I'm going to have a follow-up for you.
Sure.
In your experience with your customers, who I know, because our customers do the same thing, they engage in a lot of heavy due diligence. And it's probably heavier in this industry than it is in other places because of the uniqueness of the asset class and some of the regulatory uncertainty. In your mind or opinion, are there a couple, 2 or 3 things that your customers are looking for from a regulated framework type of perspective that either are there right now or could be developed in more detail?
Yeah. So look, I think that the number one from a target market for us, which would be like large traditional market institutional participants, the number one focus is on counterparty risk, and that can be counterparty with whom they're trading with. It can be a venue who's hosting trading. It could be a custodian who is holding their assets. And so, counterparty risk is, it's just something that investors and traders don't want to think about, right? Investors and traders want to express a view on an asset or a trade, put it on, and not get sideswiped by a counterparty risk that wasn't part of the economic proposition of the trade. And so, look, that's front and center for us. It's front and center for prior crypto market participants, and it's the number one issue for new entrants by far. And so I think that as we think about the regulations, I totally appreciate the concern about the volatility of the underlying asset. I think there's a bit of a chicken and the egg with the volatility of the asset, in that as the ownership of something like Bitcoin starts to shift into much larger, stronger hands, I think volatility over time definitionally will decline. And so we sort of have to cross the Rubicon of the chicken and the egg problem of reducing volatility by allowing market entrants to come in. And so the asset and the volatility piece aside, like, I think the regulatory focus on getting liquidity to venues where we can take counterparty risk, credit risk sort of down, not off the table completely, but down, is paramount.
Thanks, Chris. And now I'm going to turn back to the firms, David or Stephen, with somewhat of the same question. So Chris phrases this in a chicken or the egg scenario. Are you seeing this as well with your customers? Some of their trepidations or concerns about the risks in handling this kind of thing? Is this something that perhaps keeps you away from the asset class in many cases? Can you comment on that generally?
Yeah, this is Steve. In terms of the storage of said crypto and potentially us being on the hook when you have a cold wallet, warm, educating people, I think will go a long way to all the controls that you do have in place. When Bakkt went live, when the RSX went live, there was a deep dive into the controls there. And it's one of those things, it's a little bit of the fear of the unknown, but once you start to understand a little bit more what people are doing, I think that will encourage more people to say, hey, listen, I do want to get involved. Because I said before, we are hearing more and more from the institutional clients, the large professional trading groups, sophisticated clients, that there's a desire to add crypto risk to their portfolios.
David?
Sure. Well, sure. On my side, to be clear, we only handle the listed derivatives of the crypto assets. But our clients obviously have accounts directly with Bakkt, and we have a lot of confidence in Bakkt's ability to be the counterparty there and manage the physical aspect of the transactions.
Are David, I'm interested, are your customers utilizing the Bakkt warehouse as well as trading on ICE futures, or is it generally? Yes. Okay.
So we've managed physical delivery on Bakkt every month since their launch, and it has been a very seamless and smooth experience for all of our clients and ourselves as the clearing FCM. So yeah, we have visibility into the warehouse, and our clients are able to facilitate all those transactions very smoothly.
Well, that's a nice smooth segue into my next question, which I'm going to go back to Laura with. And so we look at market structure, and I know that Bakkt and ICE and exchanges look at market structure and try and design products to align with how markets operate and evolve. And I want to point out that a fundamental objective of all commodity derivative markets is to provide some sort of a price discovery process that has some integrity to it. And so, I'm going to ask you, in terms of when ICE and Bakkt got together and designed their current product, what was on your mind and what were you thinking about?
Sure, yeah. Good question. And I touched on it just a little bit earlier, but it was really important for us to design the construct of we have a monthly Bitcoin physically settled future. When we were designing it, we wanted it to be physically settled. It was very important. It didn't exist, not a federally regulated one at the time. We know, being ICE, especially, and having done this before, it's the physically settled futures contract, if it's efficient, creates the price integrity that this space, when we were looking at it, we felt like it lacked. We don't take any kind of index or price from the spot market. It comes directly from the contracts themselves. If you look at, for example, what ICE has done in the past with crude oil, for example, it's trading millions of lots a day. There are hundreds of future swaps and other option products that are benchmarked off of the crude oil contracts, and it basically provides this price transparency and kind of this risk management that the traders and the hedgers in the space need for it to be efficient, for them to be efficient and to do their job. And so that's the importance of having and creating this as our very first contract. We then launched a cash settled futures contract that trades on ICE Futures Singapore, which takes the settlement price. So again, it's air gapped from any of the kind of spot markets. And have the potential to launch more products off of this, using this as a benchmark as well.
Can you explain this term air gap?
When I say air gapped, I mean, for example, so we use a VWAP 2 minutes between 4:58 and 5 p.m. Eastern Standard Time to take our settlement price. We're not looking at any of the spot markets prices. We have zero reliance on any of the spot markets. So we're keeping it completely separate and air gapped from, in case there's any, price manipulation, market manipulation, anything like that, it's quote unquote air gapped.
One more question for me, and this will be for Brian, and then I'm going to turn to some of the Q&A we've gotten. Brian, with respect to this issue of price manipulation, is there anything that you can say from the CFTC perspective as to what your concerns are there? I will note that the SEC has yet to approve an ETF based upon the concern that over the integrity of the pricing at certain of the spot exchanges. Does the CFTC share the same concerns?
So thanks for that, Matt. I mean, I think I don't want to comment. I would love to comment on the SEC's process, but I'm not going to comment on the SEC's process. I think that is something that they and their commission has to work through of how they are comfortable, proceeding with some type of exchange traded fund or exchange traded note that references cryptocurrency prices on either from the futures contracts or from spot exchanges. From my position, we in our derivatives oversight, our standard is our products that are not readily susceptible to manipulation. So that is not, nor should it be, a guarantee that manipulation can never occur. We have preventative measures regulatorily for manipulation, and we have after the fact enforcement powers to hold those accountable and to try to provide a disincentive for future manipulative activity. I think as you look at the contracts that have had the most volume that are at least financially settled, where I think our interest in that was initially tested and was debated publicly. I thought that those indices were constructed very well. I thought that they certainly mathematically met the standard of something that was not readily susceptible to manipulation. And for anyone to try to manipulate those settlement indices, I think it would have been very apparent to the market and to us, which doesn't mean, again, it couldn't have happened, but it means that we would have certainly known about it and brought our enforcement capabilities to bear. I am very happy to see groups like this, the Global Digital Asset and Currency Association, stand up, as well as others, to try to provide more comprehensive and consistent sets of either best practices or actual standards for firms or spot platforms to hold themselves to, because I think, like Chris might have mentioned, we as the CFTC only have fraud and manipulation, but mostly fraud oversight, fraud powers, enforcement powers in the spot markets of commodities. And we need to use our resources carefully. And I think that there is a hierarchy to how we do that. I think that we would probably look to, futures contract activity first, and then probably, commodities with significant futures contracts next, and then spot, markets with some type of, disconnected but relevant derivatives contracts after that, and then just, regular, spot commodity markets if we could. That is until Congress just decides at some point in the future to give us or another regulator more authority over spot markets themselves or over the crypto spot market itself. And when I started working on Capitol Hill 20 years ago, someone came to me and said, okay, Brian, you just have to remember, Congress is good at doing two things: nothing and overreacting. And now I didn't say that, I'm quoting someone that said that, so don't attribute it to me. But the point is true. I mean, the way Congress is set up, it takes a lot of effort and hours and consensus to pass something into law, and that's the way the system was designed by the founding fathers. But usually, what that means is that something very bad has occurred to create that consensus and create that momentum and create, the energy and commitment required to pass something. So I'm really proud that groups like this are standing up, and that there's such an interest by participants, in the market to adhere to, some sense of regulatory best practices or even standards.
Thanks, Brian. And yeah, I will emphasize that that's exactly why the GDCA is standing up. And it's up till now, it's been all an entirely volunteer effort from people in the industry who recognize that there are some serious issues with a number of things in the industry that industry participants themselves can get together, work on solutions arm in arm, at least, in partnership with, the regulators themselves. And recognizing that there are some, budgetary or other resource constraints that you have. So, that's our intent anyways. So now I want to turn to some of the questions that we've gotten. And the first question I want to handle is with respect to a prime brokerage solution and what's needed for institutional players to get engaged. And I'm going to ask Chris Ferraro if he's got something to say about in terms of what he thinks from a prime brokerage situation is needed at this point.
Yeah, I mean, our view at least is, traditional market participants want the same experience when expressing a view in digital assets as they do in the current set of assets where they can express a view: equities, FX, fixed income, rates, things like that. And so what are those things? Safe custody, safe and efficient clearing and settlement, leverage, or margin exposure, so that they can have capital efficient ways to express a position, and then a whole suite of other services associated with that base group of services, whether it be short sale facilitation, lending and borrowing of their assets, cap intro, lots of sort of other services that traditional prime brokers associate with things you can provide the client. But I think those base services of safe custody, clearing, settlement, and leverage is what the market is asking for. And there have been very few places in crypto, in digital assets to date, where folks can get that all together in a safe place without introducing exogenous risks with venue or counterparty risk. And so, that's what the market wants for sure. At least that's our perspective on it. And so, we, along with a lot of other market participants, including I think most people on the call here, are figuring out how to put pieces of that together in partnership to offer that.
Thanks, Chris. I think that comprehensively answers the question, at least for now. My next question is for Brian. Brian, do you have any view on how this advisory fits with respect to Chair Tarbert's recent directive on the use of staff letters and guidance, and how that directive may impact the CFTC's staff and commission's ability to deal with emerging issues in this space in a timely and efficient manner?
Thanks, Matt. Yeah, I think that question was from Tim McDermott. Tim, hello, how are you? Hope you're doing well. Yes, I think that the advisory fits very squarely within the chairman's directive, because I think, as I described, it doesn't make new policy, at least in my view. And I know from the staff's view, they didn't want to try to take that step, and they didn't think it was appropriate to try to take that step in an advisory. And they were really just concerned with how do we provide clarity within the construct of our current rules and the limitations that are built in, that were written at a time when these things were not considered. That all being said, let me repeat that I think it is very important for us to continue to consider updating those regulations to account for the innovation in the marketplace. That will be a serious public policy and market participant discussion, but I think it's one that should happen. And I think that this chairman or the next chairman, in the next year or two, should have that conversation and should be open to doing that. I think more broadly speaking, I read the chairman's directive as basically being consistent with what current practice should be. 8 years ago, I think that there was an abuse of the no action process and the staff-led advisory and interpretive process. And while it may have been done out of necessity, given how much rule writing was occurring, and that there were always going to be, unforeseen issues, or a term that I hate, unintended consequences, because I think, a consequence doesn't matter if it's unintended, it's a consequence regardless, and you should have intended it. Otherwise, you shouldn't write the rule. But I think that was a natural process, even though it was one with which I heavily disagreed. I'm glad that this chairman has officially tried to, under his tenure, constrain that and put the power back to the commission, where there is accountability by Senate confirmation and under the APA for notice and comment. And I would also note that I think it actually goes beyond what the chairman initially had mentioned or discussed privately and publicly, but publicly for sure, an interest in basically doing away with no actions and exemptions and advisories to some degree completely. I think they are necessary in certain circumstances, and this laid out appropriately in my view.
Thanks, Brian. Okay, we're going to switch gears. Next question is for Steve Hood. Steve, can you clarify what next steps mean for an FCM? What changes need to happen before FCMs can start accepting crypto as collateral?
Sure. First and foremost, we don't deal with the physical right now, just like Phillip. So we are a regulated broker dealer. So getting working in conjunction with FINRA to make sure that they will be okay with us moving forward, accepting crypto. Proper vetting process, just past that proper vetting process of custodians, and then new processes. Okay, someone's not meeting a margin call. What do we do? How's that process work? Do you sell the coin? And then lastly, back office systems in terms of if a product or a future can only be used against a certain currency, updates to systems and processes to ensure that if someone has crypto, that's only being used against approved products like right now, Bitcoin futures.
David, do you have anything to add to that, or?
Yeah, just one quick thing. We would first, for us, I agree completely with what Steve said, but we would also look to our to the exchange to be able to manage or accept cryptocurrency as collateral as well. We wouldn't want to be necessarily doing any arbitrage between cash and crypto, managing our seg funds. So that would be a big point for us.
Great point.
Laura, you at Bakkt are typically hand in hand with your FCM members. Is this something that that Bakkt is got on the drawing board in terms of what you need to do to deliver some of this stuff to the FCMs?
We're constantly having conversations about it. There's just a lot to be put in place. I know from the clearing member perspective, they're the ones really on the hook, so to speak, especially when it comes to the physically settled futures. The delivery process, they're the ones that have to get their risk management systems set up to be able to value and understand the underlying. So we're certainly pushing for it. We definitely think it will be good for our market and good for the market as a whole. I think it would grow our market in the longer term if we could support it this way. But like I said, a lot of it is with the clearing members. So we'll do whatever we can to help them get ready for it. I work for Bakkt, which is really more of the custody, and then also handle the trading component of it. But we're always bringing in the clearinghouse, ICE Clear US, who has their own risk management group. And they have to have everything go through that risk management kind of committee. And that committee also has to report into the CFTC. So there's a lot of moving parts, but absolutely it's something that we're talking about all the time. We know that it will be only beneficial to our market. So we want to try to help out as much as possible, certainly.
Yeah, I just want to point out that, it's obvious just from listening to the various types of participants in the marketplace here, that it's an ecosystem that's codependent on everybody else, regulators, firms, clearing mechanisms. I really want to thank you all for being on this panel, because I think it just sort of evidences the interest here. Certainly we know that institutional interest is there and will continue to build, especially in this, the market dynamics that are going on right now. The interest in crypto continues to build. I want to finish up with one further question, and this is going to go to Bakkt and Laura. The question is essentially pointing out that there is a potential conflict of interest between an exchange that hosts physically settled futures and the exchange also providing the custody or warehousing mechanism. Can you speak to that and how Bakkt handles that potential conflict of interest?
Sure. So yeah, I mean, as I mentioned earlier, Bakkt in and of itself is a separate entity from the clearinghouse and the exchange. So the contracts actually trade on ICE Futures US, which is the exchange that houses all the other ICE US, North American contracts, and then it clears on ICE Clear US. And Bakkt is simply offering the custodian solution. My background happens to be that I worked at ICE prior to this, so I have the ability to help manage the contracts and build out the markets. But as far as the custodian, it is a completely separate entity. It actually helps, though, that we do have this relationship with ICE and the clearinghouse, because for the delivery of the contracts, we have a virtuous communication loop with them where we can ensure that our clients have the Bitcoin available and readily, in the right location within their warehouse accounts, so that the delivery takes place smoothly, and so that nobody, everyone's ready for their short positions and their long positions. And as Dave mentioned, it is a seamless, typically it has been for over a year, seamless delivery mechanism for these contracts. So I don't see it as a conflict of interest, again, because it's not the same. It's not one and the same. When you're looking at other exchanges, maybe unregulated exchanges, people have gotten hacked. I can't really speak to spot markets and that, such as that, but I hope that answers your question.
Yeah, sure. So just real quick, a follow-up. So if I were interested to deliver on a futures contract at expiration at ICE, would I have to have an account at Bakkt? Is that the only way to do it? Or would I be able to settle that contract using a custodianship at another custody agent?
So yeah, if you are essentially our onboarding process is if you are trading the ICE or Bakkt Bitcoin futures contracts, you have to also set up an account with the custodian, the Bakkt warehouse, because the delivery does take place within the Bakkt warehouse only.
Okay. All right.
You know,
Thanks.
just like if you have, for example, gold contracts or silver contracts,
Sure.
there's a specific place where the delivery has to take place. I can't say like, okay, I'm going to just take the gold bars from my house and take it over to, you know, Brian's house and it's done. You know, it has to be like monitored through a regulatory framework, which is in its certain location.
Okay, very good. I have one more question that just snuck in over the transom here at the 11th hour. So I'm going to throw it out there for anybody that wants to answer it. It's a question about you know, the interaction of this issue with Rule 1.25, and the question is: was there any guidance in the letter for what FCMs can do with digital assets within the framework of CFTC Rule 1.25? Has anybody got a view on that one? Steven?
I mean, 125 has to do with the investment in seg funds and U.S. Treasuries with the WAM under 2. Exactly how that would translate, what you could do with crypto, I think that remains to be seen. So I think we would need some guidance from Brian and others on that front.
Brian, any foresight into whether or not that's also being looked at the CFTC, or is that something you can't comment on?
Well, so I'm pretty sure that wasn't in the letter. I may be wrong, but I didn't see it in there, and that was not raised with me. And I think the reason it's being asked is because someone's curious about it, as opposed to seeing something that they'd like to use. And I think that you know, because we're saying in this letter, under our, you know, again, antiquated and restrictive prior rule set, you know, crypto assets and customers' accounts do not qualify for seg funds. Therefore, I'm not sure how 1.25 would apply to them if they don't qualify for it, but maybe I have that backwards and I'm not a lawyer, so don't hold it against me. But I think that issue, along with, you know, how we would treat individual crypto products or crypto products generally within seg funds from a haircutting perspective, and how we would look at an FCM bankruptcy that resulted from, you know, a cybersecurity incident where, you know, some of those assets were stolen. I mean, those are big public policy questions, and again, things that I think lots of different market participants would have different views on, as we would undertake a, you know, rulemaking process, which I would support the commission, you know, thinking about, and I would hope that they, you know, will at some point in the future.
All right.
Matt, let me also lastly just say, I've been in this job for 3 years, and I always forget to give my disclaimer that I only talk for myself. But maybe after I leave the commission, I'll finally remember to do it. But you know, just the views that I expressed here today are really just my own.
Okay. Yeah. Thank you, everybody. I want to thank my panelists. And at this point, we're a little bit beyond 2 o'clock, so 2 o'clock Central Time. So thanks again. Gabby, I'm going to turn it over to you.
Well, thank you. It's really been a pleasure to host you all today as panelists and attendees. We've had over 160 participants, both through the Zoom webinar platform as well as through our YouTube live streaming. I'm going to thank you all for attending, and I'm going to pass it over to my colleague, Kat Orfanos. Kat?
Thank you, Gabby. Hi, everyone. Kat Orfanos from DBL Digital, here to provide some closing information on today's event. First, I would also like to thank each participant and panelist for taking time out of your day to discuss and share your thoughts on the CFTC's recent guidance for FCMs holding client virtual currencies. We enjoyed each of your perspectives and invite today's attendees and the panelists to continue the conversation on social media. Thank you also to everyone who joined us live today. Your attendance and participation was greatly appreciated. If you did tune in late or would like to watch back any parts of this event, an on-demand recording will be available in the coming days, so please keep an eye out for that in your inbox. Thank you also to the Global Digital Asset and Cryptocurrency Association for hosting this event. Please visit the LinkedIn page for Global DCA or their website at www.global-dca.org to learn more about the emerging SRO and future webinars like today's. I'd like to give one last virtual round of applause to everyone who participated or helped put on today's event. We look forward to many in the future. Should you have any additional questions regarding today's event, please don't hesitate to reach out to me via email at corfanos@dblgp.com. Thank you and have a great rest of your week.